I don't think, and this is just my opinion, and maybe I'm wrong, but I don't think that AI is going to be a complete killer of every software as a service type company. There are going to be some companies that survive and prosper out of this sell-off. And if you're interested in that sector of the market, particularly after the drubbing they've taken, a lot of these stocks are down 50, 60, 70%, some more. So if you're interested in looking at that case, look at the businesses, look at the fundamentals, look at their debt structures, look at their income and revenue growth rates, those types of things, and then give them a discount. Say, if AI does what it's supposed to do, let's discount those earnings growth rates. Let's discount those revenues and sales, and then discount those and then look back at the fundamentals. And if the fundamentals are still good, even with those discounts, maybe there's an opportunity. The problem with narratives is always this. The narrative is just the justification for overpaying for assets. When something goes up a lot in price, we begin to come up with these narratives. Well, this time is different because these assets deserve these higher prices because this time is different because of A, B, or C. That's what narratives are for. But as an investor, pay attention to the fundamentals. And it's always interesting when things are going up, we're creating these narratives so we keep overpaying for prices as things are going up. But yet when something goes down 40, 50, 60, 70%, we have this new narrative why it's now going to zero. That typically never happens on either end. Things don't go up forever and things don't go down forever. And good investors are kind of more the contrarian nature. And what they're looking for are these opportunities when things become overly extended on the upside, they're taking profits, reducing their risk. And when things get extremely extended on the downside, that's where they're looking for an opportunity to buy something cheap. I get so many emails like, well, I want to invest like Warren Buffett. No, you don't, because Warren Buffett doesn't own stuff going through the moon. He's buying stuff that's cheap and boring and just makes money over time. That's Warren Buffett. You don't want that. You don't want that boring, stable type portfolio growth over time, even though he only had a 6 million % return. What you want is you want all the go-go. You want all the excitement, the gambling. You want all the flashy blinky lights. That's what you want. You don't want boring, even though you say you want boring, because, I can build you a Warren Buffett portfolio. And then as soon as the market goes up 20%, you're going to be going, well, I want the market. I don't want the Warren Buffett portfolio more. And that's experience. That's 30, 35 years of watching people do this over and over again, saying, oh, I want to invest like Warren Buffett. You don't. You want the markets until the markets blow up, and then you don't want the market at all. But that's human nature. But as contrarian investors, this is why you want to start thinking a little bit like Warren Buffett and saying, okay, where's the fundamental value? Are these stocks trading at a deep enough discount to warrant the risk? And some of them aren't. But again, you got to do a little bit of your homework there.
Catch me daily on The Real Investment Show. The link is in the description.